Great lawyers don't always know how to build great law firms. Let's change that. Join Ben Gideon as he shares hard-won lessons from building his own financially successful law firm and practical insights from top law firm entrepreneurs, business consultants, and more. This is a podcast for lawyers, by lawyers. Welcome to Elevate, Build, and Grow Your Law Firm. Produced and powered by Law Pods.
Today's episode of the Elevate, Build, and Grow Your Law Firm podcast is brought to you by Supio. I just spent an hour doing a webinar with the Supio folks. It was great. We had the head of business development and also one of the lawyers from Texas who's been an early adopter of Supio and walked through some case models of how you use Supio to put a case together. It was very, very impressive. I would encourage everyone who doesn't yet have an AI platform for their law firm, if they're a plaintiff's side, personal injury, medical malpractice type of law firm, check out Supio and get the demo. Our podcast today is also brought to you by Vision Spark. Vision Spark is the company that helps law firms and other businesses find seconds in command. You know any seconds in command, Jeff?
That would be me. It's exactly where I want to be.
When I think of number two, I always think of Jeff.
Thank you, Ben. I appreciate that.
We have Vision Spark to credit for the search process that led us to Jeff, and then Jeff has led us to the holy grail of, it appears, to doubling our revenues in less than a year of your time at our firm. So it's all paid off very well. Anybody who needs a second in command like Jeff, I would encourage you to talk to Vision Spark. Our podcast is also brought to you by 1% for Planet. 1% for Planet, folks, is the organization that allows you to contribute 1% of your gross revenues to environmentally conscious nonprofits. Our firm has done that. It's a great organization that's allowed us to partner with some really terrific nonprofits in Maine and throughout northern New England, and we really would love to have other firms join us in that. And if you do join us in 1%, please reach out to us and we'll give you a plug on the show. Welcome to Elevate, Build, and Grow Your Law Firm. I'm Ben Gideon. Jeff Wright is off today. Very excited today to have John Scott on the pod. John is a CPA working at the Anders firm out of St. Louis and specializes in helping lawyers with tax, accounting, financial planning, and other related matters. So welcome, John.
Thank you, Ben. Great to be here.
So just tell us a little bit about your background and how'd you get into this consulting and advising law firms niche?
Well, I started at Anders in the 90s, and we, like many firms, got most of our referrals from attorneys. And we loved those referrals because when you get a referral from an attorney, those folks are used to paying good fees, and so they're kind of a qualified lead. And I was very fortunate early in my career to meet a very entrepreneurial attorney who grew his niche practice from just the St. Louis area to 44 states and the UK. And I spent 17 years working with this attorney on his finance committee, watching him build his practice by paying attention to data. So it became very apparent to me that you need good, clean financial statements. You need to pay attention to data and make decisions based on that, because when you do that, if you make a mistake, you can correct that quickly. And that kind of folds into forecasting. When people set budgets at the beginning of the year and then they put them in the drawer until October, that's a useless exercise. But when you do a dynamic forecast and you look at it on a consistent basis, it's kind of like using a Waze app or a GPS for a trip. You can see if you're off course and you can course correct and you can pull different levers. And that's what we at Anders Virtual CFO Services do. We want current financial statements so that we can pay attention to data and course correct along the way to help you achieve your goals.
Can you tell us a little bit more about that entrepreneurial lawyer that ended up in 44 states and international? What kind of practice was that, first of all?
It was a family law practice, and he decided early on that he wanted to work on his business and not in it. And he got it down to a science. Every time he moved to a new city, he could be break even in 6 months and profitable after that. And he just had this formula. You go to a city, you get temporary space, you find a local managing attorney, flood the airways with ads. At the time, it was mostly radio ads and SEO, and you would get enough business to then hire that second attorney. And at that point, you were profitable. He made mistakes, but because he was paying attention to data, he could minimize the impact of those mistakes. Where so many of us just go, okay, my gut tells me I should do this. I'm not paying attention to the data. And then 18 months later, I go, boy, that was a mistake. I wasted a ton of time not paying attention to the data.
In that, I mean, I'm curious. We don't have to stick on this forever, but in that example of this lawyer who built that business, so in each different market, he's acquiring or hiring attorneys to manage the
He would
business.
hire.
And how does he keep, and this may be outside of the areas you're consulting, but I'm interested in this if you have insight. How does he keep the high or standards of practice and manage the egos and compensation, which is always a challenge with lawyers?
It is a challenge. The standards of practice, he came up with very specific guidelines and oversight to ensure that people were doing quality service for their clients and keeping them out of trouble. With respect to how do you manage the egos, he treated them very well. They weren't owners, but he treated them like owners and gave them perks that, they couldn't get somewhere else. And it was an impediment for them to then leave and go somewhere else or go across the street and set up their own shingle. Plus, the firm did everything for them. All they did was practice law. They didn't do marketing. They didn't do accounting or finance, none of the HR functions. So it really was plug and play, come in and practice your craft. And if you wanted to go across the street, you're going to have to do all those other things that you weren't doing before.
And I noticed one of the articles you have on your website had to do with equity compensation or attorney compensation model. That's something we at one point struggled with a little bit. How do you create a compensation model that incentivizes people for performance-based, behavior, retains your best people so that they're not going across the street and, competing with you and hanging your own shingle, but is also a intelligent way to compensate that doesn't overpay people for what they're doing. Have you figured out in the consulting you've done kind of what the sweet spot is for how to think about attorney compensation?
Well, if you talk to 10 different law firms, you'd have 10 different comp models. But I think one that aligns individual attorney goals with the firm goals is the one that would best fit most places. And you can tailor whatever system they have to align the goals of the individual with the firm. And I think if you do that, everybody's going to win. But if you have, you'll have firms that are just sharing overhead and there's no real growth path there. But if the firm wants to grow and the attorneys want to do better and make more and grow their practice within the firm, then what you need to do is have individual goal meetings with those attorneys and say, look, if you work towards these goals, then we're going to grow and you're going to make more money. You can put some parameters and guarantees around it, but at some point you have to align the goals of the individual with the goals of the firm.
So as you're growing, and the example of this particular lawyer or other clients that you work with, how do you balance the growth with cash flow and not overextending yourself or creating undue risk as you grow, that you're going to sort of grow yourself into bankruptcy because you're taking on more costs and staff and attorneys than you can handle?
That's where we come in. We practice profit-focused accounting, which has 4 pillars. It's cash, profitability, forecasting, and pipeline of work. And so cash being that first one, what we do is we help you set a cash target. And the general rule of thumb is it's between 10 and 30% of expected 12 months revenue. So if you are a less risky firm, hourly billing firm with great clients that pay by return mail, you can keep about 10% of that expected annual revenue in cash reserves. And that's operating cash. The safety net is your line of credit, but I really don't want you to live on the line of credit. But really, what cash do I have to retain to pay my rent, people, and other overhead expenses for the next couple of months? And if I'm a more risky firm, let's say I'm a PI firm with large catastrophic cases, then I'm going to skew more towards that 30%. So that's how we help you manage that growth. Because if you're a growing firm, even if you're a less risky firm, but you want to keep growing market share and hire new people, you're going to have to build up those cash reserves over the next few months or a year so that you can fund that growth without incurring debt. I'm not a big fan of debt in a law firm. I love having a line of credit as a safety net. And if you're going to do a big technology purchase or an office expansion, I'm fine with term debt. But too many firms strip out all the cash at the end of the year, not leaving enough to operate. And then they live on the line of credit and they spend the first few months paying down that line of credit. I think it's a bad practice that we need to kind of morph out of. And if we can get disciplined enough to leave some cash behind, then I'm never going to be paying the bank off with the next few months of cash flow.
Well, I'm glad we've been following that model and gradually increasing our cash reserve and what we call our rainy day fund. And the challenge on the plaintiff side, which is what we do, is that all of that has to be after tax dollars. We're not able to deduct any of that, those expenses. So we're paying taxes on the money we continue to keep in the firm, but
Well, and you have another challenge in that you have to fund those cases with your money. And so you have this big investment sitting in your balance sheet in prepaid case cost. So you have a bigger hurdle.
right, no, exactly. We have enormous amounts out in case costs in addition to our rainy day fund, and all of that is after-tax dollars, which really creates a drag on the cash flow of the business in certain ways. But have you found any workaround to that, or is that just a reality of the tax code as it applies to plaintiffs' practices?
Well, there's no workaround with respect to deducting those costs on a current basis, but I do see some firms that are financing those costs and then, depending on your state, are able to pass along the interest costs to the client.
It can be done. We've
But you're
just elected not to do that for various reasons.
understood. And I've seen some firms that, well, we'll come back to that.
So that rule of thumb, the 10 to 30%, it's 10 to 30% of what?
Of your expected revenue for the next 12 months.
And I guess I'm wondering
So,
about why would it be of expected revenue when the question is, do you have sufficient cash to pay your costs?
well, typically that's just a shortcut to get to, do I have 2 to 3 months of overhead cost,
So
payroll, rent?
if you had 2 or 3 or 6 months or whatever of overhead costs in a cash reserve, that would be another way to assess whether you had sufficient cash on hand.
Right. 2 to 6 months. 6 months would be more closer to the 30%.
Got you.
So the riskier firm would need 6 months of expenses.
Yeah, I mean, I had seen some, in reading business books and things, some have advocated even up to a year of overhead. I guess Bill Gates always had a year of operating costs
Well,
for Microsoft in the bank, which must have been a fair amount of money. Imagining
that's a little easier for him to do, isn't it?
I would say so. Yeah. So having that cash on hand is one way if you're growing to hedge against the risk of delayed revenue that doesn't match your expenses on a current basis, right?
Right.
And then in addition to that, having that line of credit there in case you get in trouble.
Yeah, that's really your safety net. You thought that case was going to settle, but then they appealed the judgment. So that's your safety net to get you through that time.
So you talked about using data, and we're huge fans of that. That's one of our core values is making decisions based on science and data, and we're really into that. One of the challenges in using data is figuring out what are the right metrics to track that project the health of your firm. Have you seen, I think it would probably depend on what kind of firm you have, whether it's hourly rate, whether it's contingent fee, and even within that, different types of firms probably have different. But what are some different examples of the key indicators that are most important to track for data purposes for financial planning?
You're so right. It depends on the type of law firm. So an hourly firm, you're going to look at standard rate, but standard rate is really it's not material. It really is what's the average bill rate. So what's the rate that the client sees when the biller has determined value? You could say your standard rate's $1,000 an hour, but when you send the bill out, if it's $600 an hour, that's the reality. So paying attention to that and then utilization. We like hourly billing firms to set targets for charge time of their professionals and really monitoring that because that's how we build the forecast is how much could we do based on the people we have and how many hours they can charge or are expected to charge. And then we monitor that at least on a monthly basis to see how they're doing with respect to those goals because people have, time off, vacations, holidays, and we realize it's not going to be a straight line, but are they getting towards those goals? And then in a PI firm, it's what's your cost of acquisition? Do I have enough cases coming in? And then really monitoring that process along the way. Every type of case has a specific timeline from intake to adjudication. And sometimes you find firms that there are bottlenecks internally that are slowing down that timeline. If something should take 6 to 9 months, but it's routinely taking 13 months, we got to find where that bottleneck is because we're really converting effort into a dollar at some point. And if it's taking us longer to do, it's hurting our cash position.
Are there rules of thumb regarding profitability depending on the different type of law firm model you have? What your margins
Yeah,
should be?
yeah, certainly on the gross profit side, we'd like to see gross profit between 50 and 60%. So that is my revenue minus my production costs, the people cost, including their overhead. So if I'm paying someone 100,000 and overhead is, let's say, 28%, I'm going to take revenue minus $128,000 to determine gross profit. And we want to see that between 50 and 60%. And then the rest of your costs below gross profit are usually about 25 to 30%. And so depending on the firm, you can have net income of 20 to 40%. A sole practitioner could have 50% net income, but they don't have the overhead, they don't have the people cost that a bigger firm is. And generally, the bigger a firm gets, the lower that net income percentage is. But remember, that percentage is on a bigger number. So it's okay to decline. And then, of course, if you're a flow through, you have to almost look at this before owner's compensation because really they get whatever you're paying them plus whatever's left over, right? And then in a C Corp, where I'm stripping out all the income with a bonus to all the shareholders, that net income is going to be really compressed. So again, you add back at least the bonus piece to get back to a 20% net income of that C Corp law firm. Does that make sense?
Yeah, it does. And that's we've noticed that as we've grown, our net profit number has gone down, but it's against a larger total revenue. So the absolute profit number has gone up. And it sounds like that would be typical as you're taking on more overhead to build out something bigger. You're getting a slightly smaller share of a larger pie.
Right. Especially if you add partners. I had a partner when I was a very young professional here who said, I'm not going to make less so you can make more. We have to grow the pie.
Yeah.
And the point stuck very quickly that, hey, if I want to make more money, it's not going to come from my partners. It's going to be we're going to grow this whole pie and I'll make more.
Need help on a complex personal injury or medical malpractice case? Gideon Asen accepts case referrals and regularly co-counsels with lawyers nationwide on high-value claims. The firm has recovered millions of dollars in cases that competitors turned away because they dig deeper. Ready to learn more? Email bgideon@gideonasenlaw.com to start the conversation. Gideon Asen shares fees as permitted by the laws of each state. Don't let complex cases overwhelm your practice. Elevate justice together with Gideon Asen.
I imagine a lot of times when you're working with clients, they'll ask you, quite directly, does it make sense for us to grow? Does it make sense for us to add another lawyer or move into another practice area or another geographic area, or another city or town or something? And you're assisting them in analyzing that and answering those questions for them. How do you go about doing that?
In an hourly billing firm, it's a very easy exercise. Do you have the work, and what are you going to pay this person? Then we can calculate their cost, including their overhead, and say, look, they only need 500 charge hours to pay for themselves. Everything beyond that, we can make some money on them. So if you can get them to that very quickly, yeah, go ahead and expand and do that. And then the philosophy should be, if you find a good person and you think you can fill them up, you should hire them. Not when you absolutely need somebody, because you want to look at your capacity all the time. And when you get to 85% capacity, so I don't have much left, and you find a good person, you should hire them if you're a growing firm, because if you wait too long where you have no capacity and you're burning out your people, you're at risk of losing one of those folks.
That's probably one of the most important things we've learned in our growth journey is that when everybody's coming to you and telling you they're overwhelmed, it's already too late.
Right.
I mean,
right.
you're starting to run into problems, and you really want to head that off before that happens, so that people aren't getting to that place where they're burnt out and quality control suffers, client service suffers. You're at risk of committing malpractice because you can't handle the volume of work that you have appropriately and so forth. You never want to get to that point. That's great advice. So what are some of the things when you are first hired by firms and you start to peel back the curtain and look inside and are starting to help them identify problems? What are the kind of the common sorts of problems you're seeing?
So we work on a subscription-based model. And so we have three legs of the stool of what we can or will do. The first leg is the accounting function. We'll do all the receipts and disbursements in the accounting. The second leg is advisory, where we meet with leadership, go over the financial statements, talk about capacity and anything else that comes up. And the third leg is tax. All three of these legs are independent. So there's a menu of services. You pick and choose what you want to keep, what we do, and then we set a price and we go forward. When you engage with us during the first 8 weeks, we have our onboarding process. We go through a maturity model assessment of your finance function, and we determine how you rate, and it's self-graded, so we grade it with you, how you rate in 5 areas of finance. And then you might be rocking it in 1 or 2 of those areas and need help in 3. And so we set goals over the next 6 to 12 months to get those better. And during that 8-week period, we analyze everything in your finance function, and we come up with a documented plan of, okay, these are good. Here's some suggestions for this area. And so we really dig into the whole function to figure out where the bones are buried and then help you improve upon those over time.
And in going through that process, so there's some patterns you've recognized where firms in general just tend to fall short.
Yeah, especially in chargeable firms where they hourly billing, they haven't set charge hour expectations. They don't manage it. So I had a firm that had a cash flow crisis, and it turns out that nobody was hitting their charge goals, including the 2 owners. And the 2 owners were so consumed with the cash flow crisis that they they weren't serving clients. And so we quickly identified that. And in about 45 days, we started seeing cash improve because we started managing people, getting them to work client files and serve clients and then send out bills. I had another firm that had a big cash crunch when they hired us. And they had one partner who hadn't billed all year. And billing hygiene is so important because clients don't just pay you, right? You do work for them. You solved a problem that they had and you send them a bill and they pay you. That's how it works. So we identified the fact that he hadn't billed all year. And, it took a few months because when you send out a client 6 or 8 months after you do something, the pain point's not there for the client. So it's a little harder to collect, but it did work out. And now he's one of our best billers. He bills every month, cleans out all his WIP, and it's great. On the PI side, the biggest thing I see is not utilizing your case management system correctly and missing those prepaid case costs. If you don't get those in the file and the settlement comes in and you don't pay attention to capturing all those costs, it's just as if you lost the case. You have to write those off and you get to expense it, but you don't get your money back. So in the PI world, paying attention to those details, having paralegals that really work the case management system and settlements, having those handled correctly, really leads to, keeping your cash position strong.
And
One more thing in the PI world, and I'm seeing more and more of this, where a settlement will come out, email goes out to a client that says, hey, here's a settlement, send us wiring instructions. There are a lot of bad actors out there that are spoofing emails and sending an email back. I've had two firms that hired us that right before they hired us, they got that spoof email, wired the settlement to the client, which wasn't the client, and that money's just lost. So the key is when you get that email back, pick up the phone and call a client and say, hey, I want to confirm these wiring instructions.
that's great advice. I have a colleague whose office wired $10 million of settlement money to a client, and it turned out that was fraudulent. And
Oh my gosh.
so you really, really have to be careful. We had an email that came in after a settlement that purported to be from a lien holder seeking recovery of a lien, must have infiltrated some emails or something to know that this was something we were in the process of negotiating. And fortunately, our internal financial manager noticed that the email address had 1 digit difference from the real email for the person we had been communicating with. And that was a $500,000 lien repayment. So we're very happy we picked up on that before sending the money out of the office. But this is quite, it's rampant and something people really have to try to be on top of. Are there other things in terms of just financial checks? I mean, or controls on the money flow side of it. Obviously, avoiding being a victim of fraud is always a good idea. But there's also scenarios I've heard of where employees themselves, internal to the business, are embezzling money, and you have to be concerned about that. Are there certain types of financial controls that you advise putting in place to protect yourself?
Well, one of the other pillars of profit-focused accounting is your financials, and having good current financials with separation of duties is key. Too many firms, and not just law firms, but too many businesses have their neighbor's uncle's brother do the accounting on the side. They've got a full-time day job. They do this at night, and they're 3 months behind in reconciling the accounts. And in a law firm, your trust account is super important to have always reconciled and be high and tight. And when you are 3 months behind, it's just historical. There's no benefit to that. And so if you have someone preparing the checks, someone else reviewing and signing the checks, and yet a third person or outside vendor reconciling those accounts and doing it on a current basis, then it's going to lead to two things: the good data with which to make decisions and you're going to avoid those fraud or bad actors in your operations, because you're going to have that separation of duties, you're going to have that oversight, and you're going to have good current financial information.
Do you recommend that firms occasionally have outside audits done just as a check? And if so,
I don't
how
know that you
frequently
need
would you do that?
I don't know that you need an audit unless you, if you suspected something, or if your trust accounts were just way behind, you could have agreed upon procedures, or someone in a forensic and litigation with a forensic or litigation background come through and audit that. But unless your bank requires an audit of your firm, I don't think you need that. You could get agreed upon procedures to look at certain things, especially in the IOLTA accounts. But I think if you have an outside vendor, CPA or firm like ours, reconcile those accounts, and don't have your office manager have the authority to sign those checks. Have the bank statements go to the owner's address so that they have some oversight in that, and also your CPA, so that someone else is looking at those statements to look for transactions. We're coming into an AI world that is good and bad. I think it's going to be great for efficiency on these repeatable transactions. And when we get in the accounting world, I think it can help us minimize the time on doing the actual accounting, so that we can spend more time analyzing what happened. And you're going to see AI tools that'll go, hey, this is a new vendor. Somebody should look at this and think about this. And so I think AI is going to really help us in that area, but it's also going to help the boogeyman who's spoofing those emails. He's going to get tools to come in and do bad things too.
So right now, in terms of if me as an owner, if I wanted to kind of have a second check on things, would I essentially take the books and throw it into an AI and say, can you flag any patterns or issues, or is that a viable way to do it? Or
I know people that are doing that right now.
Yeah.
What it's doing is it's looking at variances month over month, year over year, and just highlighting things that maybe you should look at. I think the other thing you should do is pay attention to those statements. Review those statements, look for anomalies, and then have an outside person or someone else in your organization do the reconciliation, as opposed to the office manager who's, creating the checks. And there's several opportunities for you to review things, right? You can review the bank statement, you can review the disbursements when you sign the checks, or better yet, in a automated area, if you go to like a bill.com for your disbursements, you're going to get your vendors to email the bills to you. You'll get an email allowing you a chance to review and approve the bill, or ask questions and not approve. And then you can hit the button and say, okay to pay. But just the owner has to be involved and have some oversight. And then there has to be an independent third-party person reconciling those accounts, so that you can minimize the chance of an error or collusion for fraud.
let me ask you about tax. What are the big issues that come up for attorneys regarding tax and tax planning?
They don't want to pay taxes, just like every other American. But I think if you, especially at year end, look at bonuses for your people, but maximizing profit sharing contributions, accelerating some expenses at year end, really, in a PI firm, in any firm, you have the ability to manage income a little bit. You can delay a judgment, push something off until January. But really going out, if you were going to make an investment in new technology, accelerating that into the current year so that we can take depreciation, or if you needed, new computer equipment, the same thing, just making sure that it's placed in service in the current year as opposed to the next year. But don't do things like, the car salesman will say, oh, Mr. Owner, you should buy a 6,000 pound gross vehicle weight vehicle and you can write it all off. Well, if you didn't need that vehicle, you shouldn't buy it. But if you were going to buy it in March or April, go ahead and accelerate that, and you can, get the deduction sooner.
Yeah, well, I can relate to wanting to pay less taxes. I mean, I feel like because of uh, the quirk of the plaintiff's practice, where all case costs are not deductible until the case resolves, you're essentially providing tax-free, after-tax loans of that money that can go on for years, and that is a real drag. But other than financing them, as you've alluded to, there's really no other workaround on that that we've identified.
Yeah, now in the plaintiff's world, there are programs where if you write it into the settlement, and I really see this in the mass tort area where you have, 20, $40 million settlements, and you can say, hey, I want to defer my fee. It has to be written into the settlement. And the fee then, let's say you have a $20 million fee coming and you say, okay, I'll take 2 and I want to defer 18. That money really goes into a deferral account, which you can control and invest with whoever your broker is. And then you can take that money out over time. It's still going to be ordinary income, including the growth on that account. But then you can smooth out your income over the next, 10, 20 years.
Yeah, right. You can structure your fees, or you can put them in a qualified settlement fund like you're describing. And the various elements of that have different levels of IRS blessing or confidence, and some of them are subject to challenge. Even that's going on now, so you have to be careful about it. But there are different vehicles that you can use there. So just finally, to wrap up, can you just tell us a little bit about what you guys offer, if there's lawyers listening who feel like they would benefit from more structure or robust accounting and financial planning in their practices? What do you guys offer, and how does that work?
The value proposition of what Anders Virtual CFO Services provides to a firm is that we bring an entire team of finance professionals to you on a subscription basis. You get a VCFO, an accountant, and a technology person, all on a fixed fee subscription basis. And it's usually about 75 to 80% of what it would cost you to hire those people internally. And you don't have a long-term commitment. If you hire a great CFO, then great. But it might be 18 months before you figure out if you made the right hire. With us, we ask for a month's notice, but you can pick and choose. Additionally, you get to keep whatever you want to keep internally, and we take the rest. So it's a menu of items that you say yes or no to. And depending on what you say yes to, that sets the price. If we get 2 months down the road and you now want us to take over your payroll administration, we just flip the switch to yes, issue a new statement of work, and move forward. So it's really a riskless way of performing your finance function. You could have a great internal bookkeeper, which we really need a good working relationship with. That's going to lessen what we do, lessen the price. We're going to make their life better, offer them some suggestions for best practices, and really work together well with them to give you the visibility into your financial statements to improve your cash position and help you achieve your goals. We look at this as a journey where you're taking a trip to get to your goals, and we're going to help you stay focused on those so that if we get off track, we can pull different levers to course correct to get you to where you want to be.
And at what level of revenue do clients typically come to you at a level of size and maturity of practice to obtain your services?
It's really between 2 and 50 billers, and I have firms that are, $1.5 million all the way up to $30 million in fees. And so it really depends. And we scale our pricing. We can do our pricing in, a 30-minute conversation and give you a firm price, but we scale our pricing based on revenue and number of employees. That's what really drives the price.
It was interesting when you were talking about a couple of firms you worked with that they had a cash crunch and they came to you, because you'd think, sometimes when people have a cash crunch, they don't go out and spend extra money on consultants or CPAs or finance people, but probably that's the time you need to do that so that you can get your house in order and get yourself back on track, right?
Right. It doesn't feel right, but that's what they actually need to do to get back on track. It's kind of like the stock market, right? If you invest correctly, you're supposed to buy low, sell high. But when you invest emotionally, you sell low and buy high.
Right. That's tends to be my strategy, and probably why I should stay out of the market. Well, John, it's been really great to talk to you, and appreciate your time today. And thank you for doing what you do and helping lawyers be able to have the financial freedom to build good law practices and to continue to grow and thrive. So thanks for doing that.
Thank you, Ben. I enjoyed it.
Thanks for listening to Elevate, Build and Grow Your Law Firm. Share with colleagues if you found it valuable. Remember, building a successful law firm takes discipline, strategy, and determination. But you're not alone. Produced and powered by LawPods.